Hello everyone, thanks for checking out my video. US stocks rallied across the board last Friday as Jerome Powell gave one of the clearest and strongest signals that the Federal Reserve will begin cutting interest rates in September. With Friday's positive session, the major three indexes posted a winning week. The S&P 500 gained 1.45% and is back within striking distance of its all-time high. With that said, we have two wildcards coming up, which are Nvidia's earnings and a seasonal bearish September. Specifically for Nvidia's earnings, many are wondering if it's gonna be another drop the mic moment or is the AI music gonna stop playing. So how should we position ourselves ahead of these two key events? Let's discuss them in this video. Do watch on to find out more. The US stock market surged last Friday as Jerome Powell confirmed the dovish pivot in his speech at the Jackson Hole Economic Symposium. For those who missed it, here are some key extracts from his speech. The time has come for policy to adjust. My confidence has grown that inflation is on the path to 2%, and we don't seek or welcome further labor market cooling. These words, in my opinion, are very dovish. Powell basically drew a clear line that they don't want to see further deceleration in the job market. It's like telling the market, we are there, it's time for a rate cut before something in the economy cracks. Obviously, Powell's words have pleased the market, who has been betting on a rate cut at the September's meeting, according to the CME Fed Watch tool. Right now, it is just a matter of how big the cut is. Anyway, as a result of the dovish words, technology stocks rallied with strength as a lower rate environment would benefit this group. Apart from Meta, the other 6 Mag 7 stocks closed last Friday's session in the green zone. Notably, Tesla and Nvidia jumped more than 4% each. Apart from the tech stocks, small cap stocks also gained on this lower interest rate outlook, with the Russell 2000 jumping more than 3% as borrowing costs will be lower for those smaller companies. Moving on, we will be welcoming the final week of August with the biggest event of the quarter, or some say the year. If you don't already know, the AI godfather and king of the chips industry, Nvidia, is set to report their earnings and guidance on Wednesday, 28 August. In my personal view, Nvidia's earnings is not just about its earnings, because they will likely meet the sky-high Wall Street expectations again. It's all about the guidance and outlook. We really don't know how will the market react after Nvidia reports its earnings, but one thing we can be certain is the ripple effect that the event will bring about. Therefore, do expect volatility and huge movements in the AI, tech, semicon and probably even software companies. We are talking about the Mag 7, the AMD, Intel, Broadcom, the Palantir and Salesforce, who is also reporting its earnings on the same day. Anyway, other big names that are reporting their earnings this coming week includes Lululemon, CrowdStrike and HP. Finally, the spotlight will also be on the Fed's preferred inflation gauge, the PCE index, which is set to be released on Friday 30th August. That will cap off a volatile and turbulent August where we saw the best and worst weeks of the year. Moving over to the technical analysis section, wow, how things change so quickly. As you can see from the chart, the S&P 500 or SPY is almost reaching an all-time high again. I like how sometimes the market is being set up so nicely ahead of a key market moving event, which is Nvidia's earnings. In my view, the earnings will set the tone for the next 2 weeks at least, and that will see SPY either hitting a new record high, which means going above 565, or it will drop back to that gap area between 544 to 548. If the next move is towards the upside, again like I always shared, at all-time high, sellers usually will dry up for a while, and SPY could go higher, potentially hitting 570 or beyond. That's when I will not FOMO and not chase the rally. But if the next move is towards the downside, I would be excited. Pay special attention to 544. This is a triple support level formed by the bottom of the gap, the critical 61.8 Fibonacci level, and the 50 moving average. The 50 moving average is actually at 547, but well, give and take a little. From the current price of 562 to 544, that's 3% decline, which is a decent pullback. I will leave it to viewers to see if they wish to pick up some shares here. Anyway, if this 544 doesn't hold, then the market is turning bearish in the short term again. But I think so long as we stay above 531 Fibonacci support level and where the green channel line is, it is not a cause of concern yet. And from 562 to 531, that's a 5.5% pullback, which is quite significant, and I will consider looking at my shopping list. Okay, moving over to Apple. Quite straightforward, so this will be a short one. First of all, Apple is on a nice little run up after it broke above the blue downtrend line. To make things even better, it has gone above the critical 61.8 Fibonacci level and has been staying above it for more than a week. But all good things will come to an end. Okay, maybe not the end for Apple, probably a break. So if Apple's uptrend gets a pause, watch that important 61.8 Fibonacci level at around 221. Maybe you can stretch it a little bit more to 220 where the 50 moving average is. If Apple goes below these two key support levels, then I think we could go below 215. But don't worry, at the end of the day, so long as the bulls can defend that 205 level, we are good. It's only below 205, I don't see much support all the way to 195. I mean, as you can see on the chart, there are these two big fat green candles that stretch from 195 to 205, which means there is little action between these two levels. On the other hand, the longer we stay above 221, the higher chance we will feel that tiny little gap between 231 to 232. But for Apple to push towards a new record high, I think its upcoming event has to impress consumers and investors. The annual new product release event will likely take place on 10 September, where Apple will probably unveil new iPhones, AirPods, and watches, so mark your calendar. Let's now move over to Tesla. So in my last video, I specifically said that I am swaying towards the boat that Tesla will go above 219. That was the second hurdle that Tesla needs to cross after clearing the first hurdle by going above that blue downtrend line. And Tesla did it. It went above 219 despite being a little scrappy. Well, it still happened, and I hope that can earn me a small like from you. Anyway, with Tesla clearing two hurdles, obviously the trend is slightly bullish now. Note, I use the word slightly because with Tesla, nothing is certain and its trend can change overnight, so it's good to be cautious. As Tesla bounces up, I had to draw a new Fibonacci levels. Okay, let's cover the upside first. Last Thursday and Friday's candlesticks are what we called the bullish harami, so that's a positive side. Another positive note is that Tesla managed to reclaim the 50 moving average after falling below it on Thursday. But for me to call Tesla moderately bullish instead of slightly bullish, I would want to see Tesla going above 61.8 Fibonacci level at 237, just like how Apple did it. Coincidentally, that is also where the huge gap is between 234 to 245. So if Tesla goes above 237 and don't get rejected at the gap area, I really think Tesla stands a high chance to head towards 250s and even 260s range. Just to add on, above 237, it means Tesla is breaking above the Ichimoku cloud resistance, a resistance that it seems to have a hard time going above since mid-August. On the other hand, a quick one if you don't mind, if you found my free content useful, do help to support this channel by simply liking this video and comment something below. I think that will help with the YouTube algorithm. Let's push this channel to more viewers. Okay, in terms of the bearish thesis, Tesla is actually not out of the woods yet. Reason being, it is still floating near the long-term purple downtrend line and the 50 moving average, which currently sits at 218. This means Tesla could fall below them anytime given how volatile the stock is. So if Tesla starts trading below these two key levels, you might want to be on your toes a little bit. This is the point where you want to keep an eye on the resistance turn support level at 207. And if 207 breaks, I think there is a high probability that Tesla will retrace further to backtest the psychological level of 200 or even the blue downtrend line. Let's move over to check out Google's chart. Google is making a little progress by claiming the first Fibonacci retracement level at 164 and more importantly stays above it. On top of that, it has kind of created a series of higher lows. To me, so long as Google can hold on to this 164 level, there is a high probability to hit 170's range. In fact, we went close last week as Google tested the next Fibonacci resistance level at around 169 but got rejected. So let's see if it tests this level again this week and whether it can successfully go above it. If it does, then Google is slightly bullish. And naturally, the next target will be 173 where the next Fibonacci level is, and followed by the gap area between 176 to 181. Along the way, do expect some resistance from the 150 moving averages as well as the top end of the gap. I will only say Google is very bullish if it can go above the gap area. In terms of the downside, of course we will have to watch 164 level. That's the resistance level that Google went above last week. So right now, it has become a support level. If this level breaks, I will personally be paying special attention to 155, where the recent low is, as well as where the 200 moving average sits. This 200 moving average is very significant in Google's context. The last time this was tested back in March this year, Google rebounded strongly. Therefore, this could be an area for me to pick up some shares or to sell put options or both. But a word of caution would be, if it breaks, then we could see a waterfall down. Yup, it's a double-edged sword. Moving over to Meta's chart, again we have to bring out the inverse head and shoulder pattern. Well, Meta did not give us a clear indication or any sort of confirmation last week as it traded sideways for the entire week. But yes, there is a but. If you look at the chart closely, it did create a new all-time high at 544. Remember what I shared, when the stock hit all-time high, sellers tend to dry up. I know we had that red candle on Friday, so what happened? Why are sellers coming in? Okay, first of all, I must say nothing is guaranteed. Secondly, one day does not make a trend. So come this week, watch how Meta moves. If it continues to create a new record high, that means the theory of sellers drying up is still valid and we could slowly grind towards 550. If we hit 550, I would say this huge bullish inverse head and shoulder pattern is playing out. And because this pattern took more than half a year to form, therefore a breakout would mean in the next 4 to 6 months, we could see 600 level. But just like what I shared in my last video, please be very careful with this analysis and do your own due diligence before you happily go and buy a call option with $600 strike price. Anyway, I stand corrected, so if Meta declines this week, please watch that 505 level. That's one important support level that bulls have to protect. If they fail to protect it, I believe the downside risk is high and that a bearish double top pattern could pan out. When that happens, not trying to scare you, but we could easily see 490s and 480s range in the weeks ahead. Okay, let's now head over to Microsoft. Microsoft had a nice little bounce off the strong support of 385 and had seemed to encounter some resistance at the 50% Fibonacci retracement level after testing it for 3 days. If the weak momentum continues this week, I would expect Microsoft to go below 416 to test the 200 moving average at 408. Just like Google, 200 moving average acts as a strong support level for Microsoft. As I zoom out the chart, you will be able to see that Microsoft only tested this level twice since it went above it in February 2023. And on both occasions where this level was tested, Microsoft went below it briefly and bounced back up quite quickly. Again, this could be one area to consider selling put options, not financial advice again. But because like I said, it's a double-edged sword, if Microsoft doesn't bounce from the 200 moving average, it is very bearish. The last line of defense lies at 385. This is another huge support level. If this level also breaks, we could potentially see 360's range. But honestly, I think that's quite unlikely to happen in the upcoming 2 weeks, unless something major happens. For the upside, it's straightforward. Microsoft needs to reclaim that 426 level that it got rejected last week. This is also where the 100 moving average is. Probably that's why Microsoft has difficulty going above, because it's like a double resistance level. By going above 426, the job is not done yet. That's only the first step towards a bullish momentum. We would want to see Microsoft going above the 61.8 Fibonacci level at 435. Then we can say Microsoft is bullish. Because by doing so, it will bring Microsoft above the 50 moving average as well, which currently sits at 434. Okay, above 434 and 435, I would say it's almost certain for Microsoft to fill that gap between 440 to 442. Alright, let's now move over to the stock of the week, Nvidia. Okay, actually, to be honest, whatever chart leading up to the earnings day, whether it's a bullish or bearish, it may not matter. Earnings could swing the chart in either direction. So let's discuss what to look out for. First of all, it's nice to see Nvidia going above and staying above the 61.8 Fibonacci level. But as shared, the past few weeks' movement may not matter. Therefore, from another angle, I would say watch this 121 level as a support. This is also where the 50 moving average is, thus forming a double support level. If the market wants to dump Nvidia shares, this 121 will likely get breached, and when a double support level breaks, it's bearish. From there, I think we can ignore the next 50% Fibonacci support level and jump straight to the 38.2 Fibonacci level at around 110. If this 110 doesn't hold, then I think Nvidia could test the psychological level of 100. By the way, from the current price of 129 to 100, that's a good 22% drop. Possible? Why not? But it may not happen in one day. Anyway, to be clear, I'm not saying Nvidia will definitely fall towards 100, okay? In fact, the same can be applied to the upside. If the market likes Nvidia earnings and guidance, who knows, we could see 20% upside in the next few weeks as well, and that will bring Nvidia to the 150s range. Okay, before we get all too excited, let's break down the details. Alright, can you see that purple downtrend line? If Nvidia can get above it this week, there is then a high chance for Nvidia to take out the July's high at 135 and charge towards the all-time high at 140. And because this is Nvidia, once we go near 140, I would expect many FOMO buyers to step in to snap up the shares, thus pushing Nvidia to a new record high in the 140s range. Alright, let's jump over to the options trading section. Just one trade to update again this week, which is this new cash secure put on Tesla. The contract was sold on 21st August last Wednesday with a strike price of 190 expiring 27 September. Well, I must say this trade is not the most ideal trade. Why so? I was a little too late in opening this trade actually. So what happened was, last Monday, 19 August, Tesla displayed 3 bullish signals. First of all, the momentum was strong during the trading session, and it was on its way to a third consecutive green candles above the blue downtrend line. Secondly, MACD had a bullish cross. Thirdly, it was trading above the 50 moving average. With these bullish signs, it was a signal for me to sell a put contract, which is a slightly bullish move. But I was a little greedy because I wanted to have a very safe strike price of 180 with good premium. As a result, the sell order that I placed on that day did not get filled. And then on the next day, 20th August, I tried to enter the trade again, but didn't even have the chance to place an order. So finally on Wednesday, 21st August, I decided to increase my strike price from the initial 180 to 190. By doing so, I am taking on more risk as the strike price has a higher chance of getting breached. Anyway, the reason why I went ahead to open this trade is because Tesla looks slightly bullish in the short term. Even if I am wrong and Tesla doesn't continue to go up from this point, so long as it goes sideways or doesn't drop too much, my trade can still profit. And since it's not the most ideal trade, I did run through the worst case scenario, which I think all traders should do it. Lay out the worst situation and always have an exit plan. So for this trade, the worst thing could happen is assignment, which means I could be forced to buy 100 shares of Tesla at 190 per share if the price falls below 190 on expiration date. And I'm actually okay with this. If you could recall, I previously had 100 shares of Tesla caught away at the same 190 strike price. Therefore, I wouldn't mind taking these shares back at the same price. Thereafter, I can continue to sell covered calls to earn more premiums, thus completing the options wheel strategy. If you are not familiar or new to this strategy, do consider checking out the video linked at the top. In fact, I have quite a few of them and they are all beginner friendly, so do watch them if you have time. Okay, sharing some thoughts on how I will be positioning myself ahead of Nvidia earnings and a potential bearish September. If you have no time to watch on, the too long didn't read version would be buy any dip that comes in the next few weeks. Okay, that's not financial advice, of course. Alright, let's go back to Powell's speech. While Wall Street had already priced in the start of policy easing next month, Powell's comments that the time has come validated those views. On top of that, he also mentioned that he sees the economy growing at a solid pace, which provides reassurance after the recent recession fears. To add on to Powell's dovish words, another Fed official, Raphael Bostic, shared on last Friday that we are close to being ready to cut rates and that we can't wait until inflation is back down to 2% to alter the policy rate. With these words from the Fed chairman and his member, the market should see the central bank announcing its first interest rate cut since 2020 in the upcoming FOMC meeting that is taking place on 17 and 18 September. Although the market is unclear on the size of the first rate cut and how many times the Fed will lower rates before the end of the year, that shouldn't be a concern. In my opinion, whether is it a 25 or 50 basis point cut, the dovish signals in Powell's speech and the imminent rate cut will likely push the market higher into year-end. And if you have been following me, you would know that I have been saying almost the same thing for the last 2 months, which is I am generally bullish towards the market till the end of the year. This is why I have sold 3 Tesla puts, 2 Nvidia puts, and 1 Google puts over the last 1.5 months. In case you don't know, selling puts is generally a bullish move. Okay, so whatever I have just shared is for the next couple of months. Here's my take on the near term, in other words, the next few weeks. Before that, I would like to emphasize that short-term market movement is very unpredictable, with 2 key events coming up, which are Nvidia's earnings and a seasonal bearish September. We really don't know how the market will move in the next couple of weeks. My message here is, don't mindset yourself that Nvidia will post a stellar earnings and guidance and the market will rally further. I mean, that could happen, but I also want to mentally prepare viewers that the market can do the opposite. Similarly, don't go about thinking that September is always bearish and then you start shorting the market and end up the market could go the opposite way. Anyway, I would like to paint you the worst case scenario for the short term, and that would be Nvidia performed well and yet there is a sell-off, and then September continues to be a bearish month. So if we indeed see a significant decline in the upcoming weeks, at least you have already heard it from me, and I hope that will help you to stay calm amid the chaos. For me personally, if any of the 2 events causes a dip in the market, I will be positioned and be on standby to pick up some discounted shares. In fact, if you have missed the buy the dip opportunity during the early August sell-off, you would want a dip in the upcoming weeks, because that could be your chance to dip your toes in. Not financial advice, of course. But at the end of the day, the so-called best case scenario could also play out, where the 2 events do not cause a pullback and the market continues to fly higher till the end of the year. On a side note, just to share, for Nvidia's earnings, according to Options AI website, the expected move post earnings is about 10% towards the upside or downside. So, would you prefer it to go up or down? And for September, would you like to see the seasonal bearish trend play out? My answer is yes to both. What about you? Let me know in the comment section below. With that, I will see you in the next one. Don't forget to tap the like button before you exit. Thank you.